Okay, now to continue class. Sorry for the interruption. Okay, so we will just need the beginning consolidated retained earnings, and as I've mentioned before, the beginning consolidated retained earnings would just be the retained earnings of the parent at the date of acquisition. Then add the consolidated income attributable to the parent and deduct the dividends paid by the parent. Okay, so this deduction class is not unique in business combination. Just remember that every time an entity declares dividends, it will be charging it against its own retained earnings. Okay, then it's possible, class, that you would ask, I thought the difference between the retained earnings of the parent and the retained earnings of the consolidated entity is that it will include the consolidated retained earnings would include the operations of the subsidiary. Then why are we then only adding the consolidated income attributable to the parent? Although that includes a portion of the income of the subsidiary, what happens to the share of the minority interest in the income of the subsidiary? Will it not be presented in the consolidated financial statements? Will it not be reflected anywhere in the consolidated financial statements? So, then we would now fail to incorporate the operations, the full operations of the subsidiary. The answer to those questions, class, is that the full operations of the subsidiary will be reflected in the consolidated financial statements, class. It's just that it will be split in multiple accounts. Okay, as to the share of the parent, it goes to the retained earnings of the consolidated entity. As to the share of the minority interest, as to the share of the non-controlling interest, class, it will go to your NCI account. It will go to your non-controlling interest account. So if you recall that if you are preparing the consolidated balance sheet for a stock acquisition, you will have another line item in your equity section. You will have another account to report, which is your non-controlling interest. Okay, and this non-controlling interest, class, would serve as the capital account of your minority shareholders. So just like in your uh, sole proprietorship and partnerships, class, if there are profits attributable to the minority shareholders, then it will go to the NCI account. If there are distributions of profit given to the minority shareholders, then it will be charged to this account. Okay? It's just that we cannot allocate individual accounts for each shareholder, so we just gather all the other minority shareholders, class. We just gather your non-controlling interest. We only present a breakdown of the equity for our parent, class. Okay. So the full operations of the subsidiary should be reported in the financial statements. Okay. But the reason that we are only adding the income attributable to the parent, meaning not the full income of the subsidiary, okay, because the share of the NCI in the income of the subsidiary is to be closed or to be reported in another account, particularly your non-controlling interest account. So again, your non-controlling interest account, class, which we will discuss afterwards, will behave similar to your partnership capital or your sole proprietorship capital, class. It will increase if there are profits. It will decrease if there are distributions of profit or withdrawals. Okay. So let's focus first on consolidated retained earnings, class. This would be the simplest formula for your consolidated retained earnings. You start with your beginning consolidated retained earnings, add the consolidated income attributable to the parent, deduct the dividends paid by the parent, then you would now have your ending consolidated retained earnings. So let's apply this in the problem that I've given you as an exercise before, class. So here we already know that the beginning consolidated retained earnings is 750,000. Let me just flash them together. So again, the retained earnings of the parent at the date of acquisition will be the same, will be our consolidated retained earnings at the date of acquisition, or our beginning consolidated retained earnings. So in this case, we will have 750,000. Okay. Now, sorry, beginning consolidated retained earnings would be 750,000. Then add the consolidated income attributable to the parent. As we have solved earlier class, for 2016, the consolidated income attributable to the parent is 214,600. 214,600. Now, deduct the dividends paid by the parent. And the amount of dividends paid by the parent class is, in 2016, is 60,000. Okay. So that means our ending consolidated retained earnings class is equal to 904,600. And that's it. You already have your ending consolidated retained earnings. Now, why would this be complicated in most problems class? It's because you might not always have the consolidated income attributable to the parent already. Okay? So a very long problem, and the very first question is consolidated retained earnings at the end of 2016. Okay? So in this case, you actually have to solve for the 214,600. Okay? And if you'll recall our discussion earlier, it was a long process. You have to solve for the income from its own operations. You have to solve for the adjusted income of the subsidiary. Then you have to deduct the share of the non-controlling interest, the share of the minority shareholders from the adjusted income of the subsidiary. Okay? And you do that just to arrive at your consolidated income attributable to the parent. Then it might even happen, class, that the beginning consolidated retained earnings would not be uh, available outright. So there are a lot of possible challenges here. Now for 2017 class, for 2017, as what I've told you, if we are just looking for the consolidated retained earnings, it will take a life separate from the retained earnings of the parent. Okay, so the beginning in 2017 would simply be the ending in 2016 class. Okay, uh, and that should already help you in computing for the ending consolidated retained earnings. But the problem is, class, in most problems, if you're asked for the second year, the retained earnings that will be given to class will be the retained earnings of the, okay? So you'll have to find a way on how to use the retained earnings of the parent to compute for the consolidated retained earnings for the second year, third years, so on and so forth. Here, it was not a problem, class, that the retained earnings given in the problem is that of the parent. Why? Because the retained earnings given in the problem was the retained earnings at the date of acquisition. And the retained earnings of the parent at the same as the retained earnings of the consolidated entity. The problem is, if it's the second year class or the third year, the retained earnings of the parent will not be the retained earnings of the consolidated entity. In this case, it's not a problem because we have solved for 2016. We can just continue with 2017. But what I'm trying to warn you, class, is in case the problem will immediately ask you to solve for the retained earnings in the third year, fourth year, so on and so forth. Okay. Now let's just try to finish this problem and discuss other problems that would present other difficulties or challenges, class. So for 2017, we already have the beginning consolidated retained earnings, but normally this information would not be readily available. We have the 904,600 because we solved it in 2016. Once you already have the 904,600, then the rest of the steps would be very easy, class. Okay, so before we make it our problem on what to do if we are just given with the retained earnings of the parent in subsequent periods. Okay, let's master first on what to do if you already have the retained earnings beginning of the consolidated entity. So all you have got to do is to add the consolidated income attributable to the parent. And as what we have solved earlier, the consolidated income attributable to the parent in 2017 is 237 200. Okay, 237 200. Now, once you already have your consolidated income attributable to the parent, recall now how much was the uh, dividends paid by the parent class in 2017. So in 2017, the parent paid out dividends in the amount of 80,000 plus. So we will now deduct 80,000. And once you have these two amounts, class, then you will already have your consolidated retained earnings as of the end of 2017. We'll try to find problems, class, in which we are asked on the 10th year and what's given is just the retained earnings of the parent. But just as a preview, class, after the first year, what would be the primary difference between the retained earnings of the parent and the retained earnings of the consolidated entity? Okay, which one do we expect to be higher? We expect the consolidated retained earnings to be higher than the retained earnings reported by the parent in its separate financial statements. Why? Because the retained earnings of the parent only includes its operations, only includes its income. But the consolidated retained earnings will also include the share of the parent in the income of the subsidiary. Okay. Now, what else would be the difference, class? Another point of difference between the retained earnings of the parent and the consolidated retained earnings would be that the retained earnings of the parent, class, includes dividend income. Okay, it will include dividend income from the subsidiary. While you'll recall, class, that the amount that we add to the consolidated retained earnings is only the consolidated income attributable to the parent. And remember, in computing for the consolidated income attributable to the parent, we remove dividend income received from the subsidiary. Okay, so if we are comparing the retained earnings reported by the parent in its separate financial statements and the consolidated retained earnings, we expect the consolidated retained earnings to be greater because it includes the share of the parent in the income of the subsidiary. But the difference, class, would not just be would not simply be the share of the parent in the income of the subsidiary, because the retained earnings of the parent includes an amount that is not included in the consolidated retained earnings. And I am talking about the dividend income from the subsidiary. So again, consolidated retained earnings includes an amount that is not included in the retained earnings of the parent. And what is that? The share in the profit of the subsidiary. On the other hand, the retained earnings of the parent also includes something that is not included in the consolidated retained earnings. And what is that is included in the retained earnings of the parent that is not included in the consolidated retained earnings? That is the dividend income from the subsidiary. Okay? So, but of course, we expect the income to be greater than the dividends declared. The income of the parent, the income of the subsidiary to be greater than the dividends paid by the subsidiary. Okay, so those two things, class, would be the source of the difference between the retained earnings of the parent and the consolidated uh, retained earnings. So if you'll be able to monitor, class, the changes or the share of the parent in the the share of the parent in the income of the subsidiary and the dividend payments by the subsidiary, you would be able to reconcile the retained earnings of the parent with the consolidated retained earnings. Meaning, you can use the retained earnings of the parent on any given date, class, to arrive at the consolidated retained earnings. And hopefully, you will be able to uh, learn that, class. I'll give you the formulator once we encounter the problem. Okay, let's try to apply what we've discussed in another problem. Okay, let's start with this problem, class. This would now involve everything that we've discussed from the very beginning, class. Just a quick glance at the questions, class. The first question would be, how much is the resulting goodwill? Okay, so we will be using what we've discussed on the preparation of the financial statements immediately after the combination. Okay, then the subsequent questions, class, would now pertain to amounts that are to be presented in the financial statement subsequent to the date of acquisition. So here, Summer Company acquires 80% in Capital Company for 250,000 in cash on January 1, 2016. When Capital Company has the following statement of financial position. Here, Summer is our parent, class, Capital is our subsidiary. When you look at the financial statements of the subsidiary, class, it would show that the total assets is 300,000. Then liabilities and equity, of course, the same. So that will tell us that the net assets, class, at book value is 250,000. How did we get 250,000? Total assets of 300 minus liabilities of 50. Or simply, the equity section. Common stock of 100 plus retained earnings of 250. Okay. Now, if you'll recall our formula, class, our table in computing for goodwill, the first row is for the consideration, the second row is for the net assets, but remember, it is at fair value. The third row is for your goodwill or gain on acquisition. Okay. The second paragraph will now tell us how much then was the book value of the net assets, class. Okay. Part of the excess of the price paid over book value is attributable to fixed assets with the remaining useful life of 10 years. The fixed asset had a book value of 40,000 and a fair value at the date of acquisition of 100,000. Summer Company uses the cost method to record its investment in Capital Company. So, out of the assets of the subsidiary, class, the fixed asset with a book value of 40 has a fair value of 100. So that means the book value of the net assets of the subsidiary as compared to the fair value, class, is understated by 60,000. Okay. Now, please take note, class, that the problem gives us the remaining useful life of the asset that has a difference, that has an excess, in which the fair value is greater than the book value. This would be relevant, class, in computing for the adjusted income of the subsidiary. Okay. So what does this tell us? That the fair value of the net assets is 250 plus 250 plus 60, that would give us 310. If we prepare our table, class, So the fair value of the net assets then is 310,000. How did we know? The book value is 250, and out of the all of the assets, one asset has a book value that is different from the fair value uh, in the amount of 60,000. Instead of 40,000, the fair value is 100. So there is an understatement of 60,000. That's why we add 60,000 to the 250,000 net assets. Now, what else do we know? Going back to the problem. The consideration paid class, the consideration paid is in the amount of 250,000. But remember, the 250,000 should be in this column because it is only for 80%. Okay. The next is to complete if you already have these two, I told you to complete the second row class. So distribute the 310,000 out of the 310,000 fair value of the net assets. The portion attributable or uh, attributable to the controlling interest is equal to 248,000. While for the minority interest, for the non-controlling interest, the share in the net assets of the subsidiary would be equal to 62,000. Now, as mentioned before, if you're not given with the fair value of the net assets, then you will have to compute for the presumed fair value by grossing up the consideration paid for the interest acquired by the parent. So 250,000 divided by 80%, this would now give us the uh, value of the company as a whole, the perceived value of the company as a whole. Now, if the perceived value of the company as a whole is 312,500 and the consideration for the 80% is 250, then that means the perceived or the presumed fair value of the non-controlling interest is 62,500. But again, always check whether this amount is greater than the share of the non-controlling interest in the net assets of the subsidiary. Here, there's no problem, so there's no need to adjust the presumed fair value. With this, we can complete the rest of the table class. That means the resulting goodwill from the combination is 2,500. And out of the 2,500 class, 2,000 is attributable to the parent or the controlling interest, while 500 is attributable to the NCI or your minority shareholders. Okay, so the answer to the first question, class, is 2,500. The resulting goodwill is 2,500. Second question. How much is the 2016 consolidated comprehensive income? And when solving for the consolidated comprehensive income class, remember you just need the income of the parent from its own operations and the adjusted income of the subsidiary. So let's check if we can get this from the given information. So indeed, we are given with the trial balance of the parent and the subsidiary at the end of 2016, at the end of the first year after the combination. Okay, so since we're focused on uh, the consolidated income class, we'll just focus on the revenue and expense accounts. Here, the sales of the parent is 150, while the sales of the subsidiary is 100. If you are asked for the consolidated sales class, in this case, it will simply be 150 plus to 100. It will give you 250. But if you're asked for the consolidated expenses class, it will not simply be 110 plus 75. Why is 110 plus 75 wrong? Because the consolidated entity does not agree with the amount reported by the subsidiary. What's wrong with the amount reported by the subsidiary? The consolidated entity believes that that amount is understated. Why? Because it only includes depreciation based on a book value of 40,000, while the consolidated entity believes that the depreciation expense that should be included should be based on the fair value of 100,000. But no need to focus on that class. Just remember that there is a need for adjustments. Okay. So solve now first for the income of the parent from its own operations. Okay. So the parent has sales of 150 and expenses of 110. Okay. So that means it has a profit of 40. Okay. Gross profit of 40. Then it also has dividend income in the amount of 4,000. But since we are going to exclude this class, since this is from the subsidiary, then simply ignore it. Do not just add it. If we were preparing for the income statement of the parent, we would have added the 4,000 because again, this is an income on the part of the parent. But in the eyes of the consolidated entity, this is not an income. So instead of deducting it class, simply ignore it this time. So 150 minus 110, the income of the parent from its own operations would be 40,000. Okay, next, what else do we need? The income of the adjusted income of the subsidiary. Subsidiary reported sales of 100, expenses of 75, so it reported profit of 25. Okay, do we add the 25 with the 40? No, because the consolidated entity does not agree that the income of the subsidiary is 25,000. Okay, just go back to our adjustment class. What is our needed adjustment? Our amortization. Go back to the excess. How much was the excess? 60,000. The book value 40 and the fair value 100. There is an excess of 60,000 to be amortized in how many years, class? To be amortized in 10 years. So every year for 10 years, we will have an amortization of 6,000. And that would be your adjustment to the income of the subsidiary. But again, what's the source of this 6,000? Okay, out of the 75,000 expenses of the subsidiary class, it includes depreciation expense related to an equipment with a book value of 40. 40,000 divided by 10 years, you will have 4,000. So that means out of the 75 class, it includes depreciation expense in the amount of 4,000. But the consolidated entity does not agree that the depreciation expense is only 4,000. In the eyes of the consolidated entity, the depreciation expense must be 10,000. And how did we get 10,000? The fair value of 100,000 divided by the useful life of 10 years. Okay, how much depreciation expense was reported by the subsidiary in relation to this equipment class? 4,000. How much should be the depreciation expense that should be reported? As far as the consolidated entity is concerned, it should be 10,000. So there's an understatement of 6,000. So if we ask the consolidated entity class, if we ask the consolidated entity how much is the expenses of the subsidiary, it would say it is not 75 total expenses of the subsidiary. It would not say that it's only 75. It would say that the total expenses of the subsidiary is 81,000. So 100,000 minus 81,000 expenses, as far as the consolidated entity is concerned, would give you an adjusted income of 19,000. So that is the amount that you will add to your 40,000 income of the parent from its own operations. Okay. Now, how else can we solve for the 19? Okay, just remember, just treat it, instead of a difference in depreciation, just treat it as an adjustment or an amortization. How much is the sales of the subsidiary? 100. How much is the expenses reported by the subsidiary? 75. How much profit is reported by the subsidiary? 25. 100 minus 75. How much is our annual amortization? Our annual adjustment? 6,000. 25,000 minus 6,000, we would get 9,000. 25 minus 6, we would get 19,000. And that is our adjusted income of the subsidiary. Now, going back to the question I posed earlier, how much should be the consolidated expenses? Again, it is not 110 plus 75. It should be 110 plus 81, because again, the expenses of the subsidiary as far as the consolidated entity is concerned is 81,000. So the consolidated expenses class would be 181,000. Okay, let me present this in the next slide. Okay. So here, the income of the parent class from its own operations was 40. And then the adjusted income of the subsidiary is 19,000. So that means the consolidated income under the entity approach is 59,000. Now we just have to deduct the share of the NCI in the income of the subsidiary to get your consolidated income attributable to parent. But before that, class, I want to demonstrate to you that another way of getting your consolidated income under the entity approach is by solving for your consolidated sales and your consolidated expenses. They are shown earlier. As shown earlier, class, the sales of the parent is 150 while the sales of the subsidiary is 100. So that means our consolidated sales is 250,000. Okay. While our consolidated expenses, the expenses reported by the parent is 110, the expenses reported by the subsidiary is 75, but the consolidated entity does not agree. Consolidated entity would say that the expenses of the subsidiary is 81. So we will add 110 and 81, not 110 and 75. So 110,000 plus 81,000. This will give you your consolidated income or profit. Okay. So consolidated sales of 250 minus consolidated expenses of 191, it would still give us our consolidated income of 59,000. The same here. Okay. 59,000. Okay, so I hope you are able to appreciate the income statement presentation. Next, share of the NCI in the income of the subsidiary. So just get the share of the NCI. How much is the minority interest? Minority interest in this problem is 20%. Okay, so multiply 20% with the adjusted income of the subsidiary. You would get 3,800. Deduct that from 59,000, you would get your income attributable to the parent of 55,200. Okay, so okay. So let's go back to the questions, class. How much is the resulting goodwill? We solved this earlier, 2,500 goodwill. How much is the 2016 consolidated comprehensive income? It was 59,000. Now, how much is the 2016 consolidated retained earnings? Okay, let's go back to our formula. Okay, so the first thing we need would be the beginning consolidated retained earnings. Since this is the first year class, we can rely on the retained earnings of the parent at the date of acquisition to serve as the beginning consolidated retained earnings. So let's check the problem if we're given with that information. The following are the balances. Here. This is from the December 31, 2016. This is from the December 31, 2016 trial balance class. But take note, the retained earnings given here is as of January 1. So we can use this one. The January 1 is the date of acquisition. So the retained earnings of the parent on January 1, 2016 would also be the retained earnings of the consolidated entity as of the date of acquisition. So we can use the 200,000 retained earnings of the parent. So we will have here 200,000. 200. And then add consolidated income attributable to the parent, which we have solved earlier. Okay, it's not the 59,000, it's the 55,200. Again, class, this is attributable to the parent lang, not consolidated income. 55, was it 55,200? 55,200. Next, dividends paid by the parent. Are we given with this information? Okay, on here, dividends declared. So in 2016, the parent declared dividends in the amount of 15,000. Okay, and this would now give us, class, the ending consolidated retained earnings. We start with 200. We add the income attributable to the parent in the amount of 55,200, and we deduct the dividends paid by the parent. We will have 240,200. This would be the consolidated retained earnings at the end of 2016. Okay. Now let's go back to the questions in the problem. After the 2016 consolidated retained earnings, how much is the amount of NCI to be presented in the consolidated statement of financial position? Okay, and this is now the one I was talking to you about, class. Wherein we will also have to make the NCI account should also reflect the profits and the distribution of profit by the subsidiary. Okay, but to arrive at the NCI to be reported at the end of 2016, you must get the NCI at the date of acquisition. But not a problem, class. We have solved this earlier when we solved for the goodwill. Okay, I hope you're able to remember. We were able to solve that the goodwill is 2,500 and that the presumed fair value of your NCI is 62,500. And this would now be the beginning balance of our NCI. Okay. So non-controlling interest. Beginning NCI as share in profit of subsidiary. Then less share in dividends of paid by subsidiary. Then you will have your ending NCI. Now, since we were able to solve earlier class that your beginning NCI is 62,500, the rest of this process class would be very simple. We're just adding the profit and deducting the dividends. It's just very similar to the capital account in a sole proprietorship and partnership. Now, share in profit. Please take note, class, that the share in profit that you will add here is the share of the NCI, not the share of the parent. Okay? This is the amount that we remove, class, from the consolidated income to arrive at the consolidated income attributable to the parent. Okay? In other words, the amount that we will add to the NCI, class, is this amount, the 3,800, the share of the NCI in the income of the subsidiary. As what I've told you, the entire profit of the subsidiary will be reflected in the consolidated financial statements. It's just that it will be split between the equity of the parent and the equity of the NCI, which is just your NCI account. Everything that is for the NCI, for your minority shareholders, is reflected in your NCI account. Okay. So the amount that will be added here, class, would be 3,800. Share in the dividends paid by the subsidiary. Let's go back to the problem. Okay, did the subsidiary declare dividends in 2016? Yes, 5,000. Do we deduct the entire 5,000? No, because the 5,000 do not just go to this NCI. Remember that 4,000 here even went to the parent. So out of the 5,000, class, 4,000 was given to the parent, which makes sense because the parent owns 80%. So the amount that goes to your minority shareholders, class, is only 1,000. Okay? Or how else do we solve for 1,000? You multiply 20% with 5,000. So this would be 1,000. And this would already give you your ending NCI class. 62,500 beginning NCI at the date of acquisition plus the NCI's share in the profit of the subsidiary. Again, adjusted profit, always adjusted, class. Minus the share of the NCI in the dividends paid by the subsidiary. You will already have your ending NCI. Okay. So basically, class, we have already discussed two additional items that are commonly asked for financial statements prepared subsequent to the date of acquisition: consolidated retained earnings and non-controlling interest. Okay. Now let's do the amounts to be reported in the 2017 financial statements as well. So start with consolidated profit, class. So for 2017, income of the parent from its own operations. Check the problem. This is the information for 2017. So in 2017, sales is 200, class, and expenses is 160. Ignore the 8,000 because we just need the income from its own operations. So 200 minus 160, the income of the parent from its own operations is 40,000. Okay, I'll move the 2016 information, class. Let's just show it as well. Okay. The income from its own operations is also 40,000, the same as last year. Okay, but we're not just copying. We computed 40,000 by 200 minus 60. Now, adjusted income of the subsidiary, Sales of the subsidiary is 100. Expenses of the subsidiary is 85. So it has a profit of 15. But what's wrong? The consolidated entity does not agree that the profit of the subsidiary is 15. It believes that its profit is overstated by 6,000, representing understatement of depreciation. So this would not be 15,000, but this would be 15,000 minus 6,000. This would give us 9,000. Okay? I hope everyone is able to follow the 9,000 class. 15 minus the amortization of the excess in the amount of 6,000. Next, you will already have your consolidated income under the entity approach. 40 plus 9,000, you will have 49,000. What's next? Share of the NCI in the income of the subsidiary. So, again, adjusted income. So the adjusted income of the subsidiary is 9,000. Minority interest is 20%. So 9,000 times 20% will give you 1,800. If you already have the 1,800, just deduct it from your 49,000. You would get your income attributable to the parent. Okay. But what if we are asked to prepare the consolidated income statement class? Let's compute for a consolidated sales. 200 plus 100. We will have 300,000. Consolidated expenses. For consolidated expenses class, we will not just add 160 and 85. What's wrong with 160 and 85? The consolidated entity does not agree that the expenses is only 85. It's understated by 6,000. So we add 6,000. So the expenses of the subsidiary in the eyes of the consolidated entity is 91,000. So you will add 160,000 plus 91,000. This would be the expenses in the eyes of the consolidated entity. If you already have your consolidated sales and your expenses, you should be able to get your consolidated profit, which is 49,000, which is the same as what we have solved above. Okay. So how many questions were we able to answer already? Income under the entity approach or consolidated income, share of the NCI in the income of the subsidiary, and income attributable to the parent. Also, we are able to solve for consolidated sales and consolidated expenses. Next question in this problem is, how much is the we already have the income to the parent. Next is, how much is the consolidated retained earnings? Okay, no problem. And this would be simpler class because we have already solved for the ending in 2016. The ending in 2016 class would most definitely be the beginning in 2017. So no problem here. Next, just add the income attributable to the parent. How much was the income attributable to the parent class as what we've solved earlier? 47,200. Then deduct dividends paid by the parent. Go back to the problem. How much dividend is paid by the parent in 2017? In 2017 class, it paid dividends in the amount of 20,000. So we will be deducting 20,000. So that means the ending consolidated retained earnings for 2017 is equal to 240,200 plus 47,200 minus 20,000. You would get 267,400. Last question. How much is the NCI to be presented in the consolidated statement of financial position as of December 31, 2017? Okay, and we can solve this already, class. The beginning NCI for 2017 would again be just the ending NCI in 2016. So again, no problem. Next, add share in profit of subsidiary. Whose share? Only the minority shareholders' share. And how much is the share of the non-controlling interest in the income of the subsidiary? In the adjusted income of the subsidiary, go back to our computation class. It is 1,800. Now share in the dividends paid by the subsidiary. Go back to the problem. How much dividends was declared by the subsidiary in 2017? 10,000. Okay, how much was given to the minority shareholders? Only 20% plus. So 20% of 10,000 would be 2,000. How else are we going to make sure that it's really just 2,000? Because out of the 10,000 class, if you look at the income statement of the parent received 8,000. And it makes sense because the parent owns 80%. So out of the 10,000, 8,000 was given to the parent, 2,000 was given to the minority shareholders. Okay, so 2,000. And this should give us our ending NCI class in the amount of 65,300 minus 2,000 plus 1,000. We will have 65,100. Okay. So again, basically, class, we have reinforced our discussion on the computation of consolidated income or profit class, and we've discussed now on how to solve for consolidated retained earnings and on NCI to be reported in the consolidated financial statement subsequent to the date of acquisition. So please expect another exercise for next meeting that will highlight the items discussed in these videos. Okay, so that will be all for tonight. Thank you.